I think you can take a snapshot in time, maybe a 1 or 2 year period, looking at some standard moving average levels, and see if the stock actually reflects that it relies on those. You know, if you find
Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Charles Schwab. I'm Joel Alconin, your co-host, interviewing Brad Thomas of REIT Investor. He is an expert in REITs, trading REITs, analyzing them. Brad, how you doing today?
Doing great, thanks.
All right, thanks for coming on the show here. We got some big problems in the S&P futures this market, trading down almost 20 handles. Now, in being involved with the REITs and everything, I mean, how much attention do you pay, like, just to the overall market, to the S&Ps, to the general trends in the market?
Well, I'll say a little familiar with what's going on out there, obviously in the macro level, and we've seen a lot of I would say trading volatility in the REIT space overall as we prepare for interest rates to rise eventually. But I really don't pay too close attention to the day-to-day minutia. I pretty much just stay close to the real estate sector.
Okay, so let's backtrack a little bit and let's talk about your website and what kind of expertise you offer at your website.
Sure. Yeah, I have a website. It's www.iREITinvestor.com, and iREIT is really an abbreviation for the Intelligent REIT Investor, which is also the name of my newsletter that you can find on the website. So I write a lot of articles, not only for the newsletter, but I provide a lot of free content as well for a lot of different companies, Seeking Alpha, Forbes.com, a number of websites, and just started with Investopedia. So I really try to put a lot of content out on the street, really to educate individual investors in buying and selling the best REIT securities out there.
Okay, and boy, you mentioned something there. You talked about interest rates, and you said, I think the word that you used was eventually, and taking one out of Janet Yellen's book, For Some Considerable Time. Let's put some kind of time, between those two. Let's try to quantify this. I mean, the economic data that's coming out is not knocking anybody's socks off here. What are you looking for, from what the Fed is saying and what's your crystal ball telling you?
Sure. Well, I think you hit the nail on the head here. I mean, what's interesting when you look at real estate, the real estate fundamentals today, and I'm not talking about just REITs. I'm talking about overall commercial real estate in the U.S. We're seeing a very healthy economic recovery right now. I mean, I've gone through and I read a lot of the earnings calls for a number of REITs, and what we found is that a lot of the occupancies are improving across the board in most sectors, whether it's hotels or shopping centers, even malls. So when we look at the broader real estate market today, we're seeing an improved economy. Now, obviously, when rates start to rise, that's going to signal one thing, that the economy is getting stronger. The Federal Reserve really has one primary responsibility, in my opinion, and that is to monitor interest rates, to make sure we increase and decrease when needed. And so when you're right, the considerable time factor that was referenced recently, it's going to take some more time for, obviously, the jobs number is one of the big indicators that the Fed's looking for. But when rates do begin to rise, what that means is we've got a stronger economy. So in the real estate world, we see rents starting to rise. We see hotel rates rising. We see self-storage rates rising. And so when rates rise, that means that earnings will rise, profitability rises, and of course, for us REIT investors, dividends rise. And the other thing that's interesting, if you look at dividends today, a number of the REITs are starting to increase, have already started increasing their dividend payouts. And so we're seeing that very healthy signal out there in the market. One thing you'll hear me say a lot or read a lot in my writing is that the safest dividend is the one that's just been raised. And so we're seeing a number of REITs that are starting to raise their dividends, and that's a very healthy environment for investors.
Okay, could you give us just a symbol here? I don't have. Is there a general REIT index that I can pull up just while we're doing the broadcast here?
Sure. Well, I mean, of course, I provide a portfolio in the newsletter. There are a number of REIT ETFs and mutual funds. I really don't follow those very closely, to be honest with you. I really think for the average investor, it's not really hard to get into the REIT space. Now, in terms of, with just a few REITs, obviously you don't want to own one REIT, but, what I try to provide for investors in my articles is, a variety of different sectors out there today. But when you talk about, the best, how REITs are performing today compared with, say, the S&P, the REITs are up today around 15 to 20%, depending on, there's mortgage REITs and equity REITs, and we don't necessarily probably have the time to get into that mortgage REIT space. And I don't spend a lot of time writing on that particular sector. But when you look at the performance of REITs today, what you really have to do is drill down to the individual sectors that are out there. So we see, a variety of what I call the primary food groups, being the office groups, the hotels, the shopping centers. But what's interesting, we've seen now recently over the last several years, a lot of new sectors coming into the space. For example, data centers are now a defined sector in the real estate world. Campus housing is another sector. So when you look at performance today, we see a lot of different companies out there. And when you go back to interest rates, if you don't mind, I'll go back and talk about that as it relates to the triple net REITs, because I've spent a lot of time writing about the triple net. These are the single tenant, freestanding, or what I call standalone properties, and they've had the hardest sell off in the space. In fact, last year, when the Fed just started to talk about rate increases, back I believe it was May the 21st, when Bernanke was talking to the Fed, that's when we saw a pretty substantial sell-off, and especially in the freestanding or triple net space. That sector was down around 15 to 20% across the board. And so what was interesting, it really made in my opinion, a really opportunistic time for investors to go in and buy those type of REITs, because they were really trading at a lower cost towards the end of the year. This would be in December or even January of this year. But a lot of that was really driven on the fact that, these REITs have long-term contractual leases, and the market really considered them to look more like bonds, which we all know they're not. They do have, built-in rental increases. So, anyway, that's kind of where I think the market is today. You really have to focus on the individual sectors, and that's what I offer in my newsletters, a lot of different sector research on the various REITs out there.
Okay, when I did some research on you, I found that you're a lifelong student of Benjamin Graham, and that he conducts all of his research and you conduct all your research and analytics on his principles and investment strategies. Could you just briefly explain those?
Sure. Well, it's pretty simple. You in this world of investing, you're either a speculator or an investor, and Graham spent a lot of time writing about that in his books, The Intelligent Investor, as well as Security Analysis. The Intelligent Investor being one of my favorite books of all time, and I have that on my website as well. But when we talk about investing, there are really two different ways to invest. And I'm not a market timer. I don't go in and try to provide investors with short-term trades. That's one reason I'm not a huge proponent of mortgage REITs, because those are really more, I call, timing stocks. They're not long-term buy and hold stocks. So I like to find those securities in the real estate world that offer the most compelling long-term buying opportunities. And these would be companies like Realty Income, for example, ticker symbol O. They've increased their dividend for 20 years in a row. It's a very stable company with a very stable dividend. And so I look for, again, dividends are really important for REITs for obvious reasons, because by law, REITs are forced to pay out 90% of taxable income. That's really the primary value proposition for investing in a REIT, is because of the safety of that dividend and the higher dividends that they pay out, again, forced component by law. So I look for companies that are very stable, that have really relatively conservative balance sheets and really are able to survive, tough economic times. Of course, the last big event we had in the real estate world was the Great Recession, and a number of REITs were forced to cut their dividends. There were, however, about a dozen that continued to increase their dividends throughout that period. And I look for those type of businesses, again, that are able to survive. As we're now approaching this rising interest rate market, I really try to offer strategies that help investors mitigate the risk of these REITs in a rising interest rate environment.
What is the what's the dividend payout on this Realty Income corporate common stock?
Sure. Off the top of my head, I don't know the actual payout. The yield today is over 5%. We're seeing a little volatility with some of these REITs. Again, back to these triple net REITs, which are the market kind of perceives them to look like bonds. And so last I checked, Realty Income was paying somewhere around a 5.3 or 5.4% dividend. Again, I haven't checked today, but that's a very competitive yield today, especially when you really drill down to what makes up that dividend. And this is several thousand properties in 49 states, very diverse portfolio. In fact, arguably one of the most diversified portfolios in the REIT world, in the real estate world. They've got a number of different tenants. Some of their better known tenants that you might recognize would be Walgreens, FedEx, the dollar stores, both Dollar General and Family Dollar. A lot of investment grade tenants in the portfolio. They've got just under 50% investment grade rating rated tenants. So again, a very stable company. They've got a high caliber management team that really has been delivering this very predictable revenue stream.
This chart doesn't alarm you at all here. I mean, you're getting your 5% here, but this stock has fallen off a cliff from 45 to 41. Obviously, eroding some of your principal. No concerns though here. You just even in the
absolutely none at all. And I don't mean to say that in a modest way. But look, I mean, this is a buying opportunity. When I see a blue chip stock, and that's exactly what Ben Graham would say if you were with us today. I mean, whether it's a REIT or a C corporation, when you see a company with these type of fundamentals, there's absolutely nothing wrong with this stock. The fundamentals are as strong as they've ever been. And so just because the market is selling off, that's the price. I generally ignore that price until I do the last thing in my research, and that's decide if I want to buy it. So take the price off the table here. This is one of the most stable, predictable companies out there. So why is the market pulling them down? Who knows? It may be because they look at Realty Income as a bond. But to me, that screams this is a buying opportunity today.
Pretty emphatic about that. Okay, let's talk about the recent trend of going to a REIT. And some of these stocks, I mean, the one that sticks out in my mind the most is CenturyLink. A slow-moving stock, just doesn't really have a lot of action. Then they come out in August, or believe at the end of July, and they come out and they say that they're converting over to a REIT. Well, it has the most ridiculous move I think I've ever seen a low beta stock like this have. Goes up to 45.67, and now it's wild, come all the way back down under 39. What do you think of this ploy, by some of these companies saying, we're going to convert to a REIT, and what are some of the benefits that they can reap by doing that?
Well, first of all, and that's a great topic, and I just finished writing an article on that very subject. We hear the word a lot, the word loophole, and first of all, that is a myth, because what these companies are doing is they're not trying to avoid paying taxes. Certainly, they will pay taxes. The taxes will be paid out at the individual level and not the corporate level. So when you see a company that has a lot of cash flow that they're pumping out and they want to convert to a REIT, again, I want to make sure this is clear. It's not a loophole, because the taxes are going to get paid at the individual level in the form of dividends. So that 90% of taxable income, and by the way, most companies pay out 100% of taxable income in the REIT wrapper. But when they're going to pay those, the taxes will get paid at the individual level as investors, receive the taxes. So that's number one. Number two, we really haven't seen any. The laws haven't changed. Since President Eisenhower created the REIT laws back in 1960. The definition of real estate is the same, and so I wrote an article recently on Windstream. Windstream's another example that this company is. What they do is they transport along cable lines, and that's what they're defining as real estate. Well, that definition has never changed. When Congress created the REIT laws in 1960, we anticipated there would be railroads to transport product across the country. So this is really no different that we're seeing today. So I think from my perspective, and from an individual investor perspective, it creates more opportunities for investors. Now, from a company perspective, if they qualify as a REIT under the IRS guidelines, and IRS they don't create the laws; they just help to create the vehicle for the companies to determine whether or not they can be considered a real estate operation or not. One company that I'll point out is Iron Mountain. Iron Mountain does own a significant amount of real estate. They also lease quite a few properties. But the question with yes.
Well, why would they take a stock like CTL up, $7 on something like that? Is there that much perceived benefit by them going to a REIT if in fact they can?
Well, if there's value there, sure. And it really boils down to, I haven't looked at that particular company in detail, so I can't tell you whether, how much real estate what the real estate is and how to define the real estate. Again, there's some questions in terms of what's the definition of real estate. And then the other law is 75% of real estate or real estate related income. You have to have at least 75% of that. So I can't really tell you with that specific company whether they would qualify or not as a REIT, but certainly if there's value there, that makes a lot of sense. Check an article I wrote today on Bob Evans, one of the leading activists, the largest owner in Bob Evans stock. And again, remember, Bob Evans owns restaurants, and they also have product in the grocery stores today. Bob Evans has been around a long time, and again, a public company, BOBE. And so one of the activists has come out and said, look, this company should not be converted to a REIT, but it should take its real estate and convert it or sell it, monetize it, in other words, via a sell-leaseback structure to a REIT. And that would provide considerable value, locked up value for the real estate. So that's really what I see out there is certainly there's opportunity if there are, if a company has real estate today and they can unlock the value, whether it's either to convert to a REIT or sell their real estate to a REIT, that certainly makes a lot of sense.
Okay, we've had Brad Thomas on of iREIT. He is an expert on REIT investing. You can check out his site at REITinvestor.com, who is unshaken by the declines here and some of these issues and looking for continued value in REITs. Brad, thanks for coming on, and we hope to have you on again soon.
Anytime. Have a great day. Thank you.
Okay.